Okay, so we looked at, we were interested in LIBOR because LIBOR is the benchmark, the default benchmark for floating rate issuance. Okay, and LIBOR is the, here I'm writing YTM, just to avoid having to write a big word like yield. Okay, I'm going to make it even better and make it only, I'm going to now, if I use this symbol percentage, that means I'm referring to an interest rate. Okay, it could be either a YTM or it could be a yield on a deposit. So normally, as a market convention in finance, we don't use the word YTM for money market instruments. Okay, we just say yield, but I'm just using it because I'm using shorthand. But I'll just use the percentage sign. That means I'm referring to an interest rate. It could be a money market deposit yield. So here we use the word yield. We don't use the word YTM. YTM is something we reserve for coupon paying bonds. Okay, for bond market instruments which have coupons. That is, strictly speaking, when you're talking to people in the market, you should not use YTM for money market securities. We just use the word yield. But I'm just going to use percentage now for everything. Yield on deposits, YTM, everything, just for shortcuts. Okay, so we want to extend, and obviously this is the LIBOR is the yield on euro-dollar deposits. Okay, strictly speaking, it is USD LIBOR is the yield on euro-dollar deposits. Actually, this is a euro deposit, but this is because it's US dollars, so we say euro-dollar. If it's a yen deposit, we say euro-yen. Okay, so now then what we were looking at, the reason we got interested in the interest rate swap curve. Okay, and notice that even in the last class I have used expressions like IRS. I have used these expressions. So this is the expression. Again, I should not use the word euro-dollar here. It's a euro deposit yield curve that is more important. Okay, so what we were looking at, why did we look at the IRS yield curve? We looked at it because it is the equivalent of the euro deposit yield curve for maturities longer than 12 months. Okay, because deposits are from money market securities, so therefore they are only up to 12 months. Okay, so if you want to go beyond 12 months for the same grade of credit, which you saw in that particular instance, that we looked at, so was it page 7? Yeah, this is even that is too. Yeah, we looked at the situation here, which, all right, you can see this. We looked at the situation where this company ABC initially has a floating rate loan, and then it wants to manage the risk. It does not want to remain exposed to floating rate LIBOR, to 6-month LIBOR, and therefore it enters into an IRS, and this is the IRS. This transaction is the IRS. All right, I should not point with my fingers, but with this. So this transaction is the IRS, where they're swapping the fixed cash flow with the floating cash flow, and because you're able to exchange, because you're able to receive 6-month LIBOR flat against a 6.38 fixed rate, we say that this is the IRS rate. Okay, this is the IRS rate for 5 years in this example. Okay, so therefore this is that's why we are saying that effectively this is the point we were discussing, I think, in the last part of this class, of the previous class, that why do we say this is an important point to understand, that we have a particular interest in the AA rated credit curve. Okay, we have a particular interest in the yield curve for AA rated credits. Why do we have this particular interest? Because when there are so many different classes of ratings, AAA, BBB, and all that. Why are we so interested in AA credits? Because AA credits is essentially what you see in the LIBOR in the LIBOR yield curve, right? And because most of the floating rate issuance in the world happens against LIBOR, are you following what I'm saying? Why are we so interested in the yield curve for AA rated credits? Remember, for every type of credit, there's a different yield curve, because you saw that chart of different credit spreads. Okay, for when you change the category of credits, you remember all these credit ratings that you have. Further up, we have given you the list of credit ratings, right? So we have a particular interest in the AA rated credit, in the yield curve for AA rated credits, because the LIBOR rate, okay, is the yield curve for AA rated credits in the money markets, because LIBOR will only run from 1 month to 12 months. Okay, so therefore the LIBOR is so. And why are we so interested in LIBOR? Because most of the floating rate issuance in the capital markets, global capital markets, happens against LIBOR as a benchmark. Okay, so some people price at 75 basis points over LIBOR. Some people very good quality credits may actually be able to price below LIBOR. Okay, but the reference is always LIBOR. It's not the government bond benchmark. Is this important point clear? In the bond markets, the reference is the government bond benchmark. Okay, but in the floating rate debt, whenever you're issuing floating rate debt, the default benchmark is LIBOR. That's why we have a particular interest in and LIBOR reflects a AA credit risk. Okay, and so therefore we have a special interest in the yield curve for AA rated credits. Okay, and then we have also, because most companies will have similar concerns if they issue 5-year debt at LIBOR, they may not want to remain exposed to floating rate interest rates, floating rate risk for 5 years. So they may have a particular interest in moving into effectively hedging and effectively getting a net cost of debt which is fixed. So removing the risk, as you can see here, the 6-month LIBOR will cancel out. You can see that. Yeah, everyone can see that. The 6-month LIBOR cancels out, as Guy pointed out yesterday. The net rate is 6.38. So many companies have an interest in this, and the way you achieve this is through the interest rate swap market. And this is the interest rate swap transaction, the most basic type of interest rate derivative product. Okay, so therefore we have a particular interest, so what we say here is what we discussed. I'm just recapping here the last part of the previous class, that the IRS rate is the equivalent of the LIBOR rate for maturities beyond 12 months. Is this point clear to everyone? Because you're able to exchange here. What is the company doing? They're exchanging the IRS rate for LIBOR flat. 6-month LIBOR in this example, you can take a different rate. There'll be only a few basis points difference if you did it against 3-month LIBOR. Okay, but the point to understand is that they're able to exchange a flat LIBOR flow, a flat LIBOR cash flow here. This means that every 6 months, what will happen is they'll find out what does this transaction mean. Every 6 months, they're going to find out what was the fixing for 6-month LIBOR, like 6 months ago. Remember that LIBOR is set in advance and paid at the back end, just like your bank fixed deposits. If you invest in a 1-year fixed deposit with the Yes Bank, okay, then what happens is you invest today for 1 year, right? And they tell you the rate today itself. Suppose it's 7.5%. So they let you know today itself that the rate you're going to get is 7.5%. But the interest is paid to you at the end of 1 year. Okay, right now, of course, they have quarterly compounding and all that, but let's forget all that. But let's assume that that didn't exist. They would pay you the rate at the end of 1 year. At the end of 1 year, you get your P plus I back. Is everyone clear? Okay, so the point is, for most money market instruments, your setting is going to be at the front end, and the payment is going to be at the back end. So it's not the new concept. You know how bank fixed deposits work. So the interest rate is declared to you at the beginning. So the rate is determined at the beginning, but the cash flow is paid at the end. Okay, so every 6 months they will figure out what the 6-month LIBOR fixing is, and 6 months from that date they will have to exchange cash flows. This SCB will receive 6.38% fixed, and ABC will receive whatever the 6-month LIBOR fixing was 6 months ago. Is everyone clear about this? This is how the system works. Okay, and they will just, because this is a pure interest rate swap, so this business will go on. It's a 5-year transaction, so it will go on for 5 years. After 5 years, it will stop. Okay, so every 6 months they will exchange cash flows. In fact, what happens is they will find out who owes who money. There won't be a gross exchange of cash flows. There will be only a net exchange. So if they find that on the first payment date, if they find that the relevant 6-month LIBOR rate is 5%, okay, and the fixed rate is 6.38%. In that case, what will happen is ABC will pay 1.38% to SCB. Is everyone clear? Because the LIBOR rate was fixed at 5% 6 months ago. So when we come to the actual payment date, the first payment date, we find that ABC owes 5%. Sorry, ABC is entitled to 5%, okay, from SCB, and it owes 6.38%. So here we say that there is a net payment due from ABC to SCB of 1.38. Is everyone clear about this? Okay, so that is actually how it will operate in the markets. That ABC will make a 1.38% payment, okay, to SCB, okay. And obviously, when you do an interest rate swap, you also have to fix the notional, what is called the notional principal. So typically what will happen if this transaction is a perfect hedge, we are looking at this as the hedging situation. Is this clear? Now what have I said here in the example that I've given? I must have mentioned, this is, see, 100 million, okay? This NPA stands for notional principal amount. You can see it will be defined earlier in the book. Okay, so obviously any kind of interest payment, this is common sense, okay? No interest rate payment can be, actually when you have to make the interest rate payment, you will obviously have to know what the principal amount is. Can you ever calculate an interest liability without principal amount? No. Right? You can't. So you always need to know, if you have to figure out your interest liability, you will always have to ask this question, okay, what is the principal amount? Right? So when you do an IRS, you will also have to specify what is the principal amount on which this applies. Okay? So now if this transaction is to be a perfect hedge, we assume that they have issued $100 million worth of FRNs. Okay? They have an FRN for 100, they have an FRN liability for, that's how it will be a perfect hedge. So if they have a $100 million FRN liability here, okay, so every 6 months they have to pay 6-month LIBOR on $100 million. Now they've also done an IRS for $100 million. So therefore the 6-month total liability on the 6-month LIBOR legs will cancel out perfectly. Is this clear? That is why, that is if you want to make this as a, if you want to structure this as a perfect hedge. But as we discovered in any kind of active or dynamic hedging program, it is the discretion of the corporate treasury as to how much you want to hedge. You may have a loan liability for $100 million, but you may decide to hedge only for $50 million or $25 million, because you might feel that here what you're doing is you are paying the fixed rate, okay, paying the swap rate, okay, so you're paying on the swap. So therefore, if you let's say as a treasury, as a corporate treasury, okay, if you issued a FRN for $100 million and you did an IRS only for say $25 million, okay, then what can I assume about your view on IRS rates? Is my question clear? Do you think that, are you of the view that IRS rates are going to come down or they are going to go up? Remember, IRS rates are just an instrument that is trading. It is something that you can enter into. Yeah. Is my question clear to you?
It's clear.
Okay, if he thinks the question is clear, Lucky, go ahead.
So if we are hedging $25 million, that is 1/4 of $100 million, so we are of the bullish view that the IRS is going to rise.
Okay. Well, okay, let me clear for the rest of the people question. So he has understood the question. Okay. Now the question is,
if we are hedging only 1/4 part, because if we hedge.
Yeah, I got your point. I got what you said. At least what is clear is that you have understood the question. The question is, if I see a corporate treasury which has issued a FRN for $100 million, they have raised $100 million. Okay.
It is going to down.
Now you're changing your answer.
Yes.
Okay. So good that you've actually picked up on the question. And so the question that I was asking is, if I observe that a corporate treasury which has issued FRNs of $100 million, they've raised $100 million of capital, okay, through an FRN, and but they are exposed that obviously the FRN is against a floating rate, but they are of the view that interest rates, there is a long-term risk of interest rates rising. But in the short term, if they hedge only 25% of that liability through an IRS, they only do an IRS for $25 million. What does that say about their, at least their short-term view about interest rates, okay, about the IRS rate? And so that was the question. Is the question clear now?
Yes.
Okay, so is Sahil, question is still not clear? Yes or no? Question is not clear. Okay, why don't you come and sit next to Nimish? That will be a little clearer. That will also leave Achal some without anybody to talk to. That is good. Okay, I know, but come here, come and sit next. Let's pack up the front benches.
It is not that your voice is not coming.
No, that's why you need to come here. So
your voice is coming, sir, but the question is not clear.
Okay, but that's okay. Come and sit next to Nimish anyway. I want to pack the front benches. Come. No, it's not fine there. Don't worry. Otherwise, you'll face a fine on your CP points. Come here. Come. Don't waste my time. Okay. So is the question clear to everyone?
Yes, sir.
Is the question clear now?
Yes, sir.
To everyone? That if I see, Bell is still not clear. The question is, if I see that a corporate treasury which has a $100 million liability okay, on an FRN, okay, floating rate liability, and overall the macro view is that they would like to hedge, okay, but tactically speaking they have hedged only 25%. So in the short term, what can I infer? If I see them doing this, okay, I observe their actions, these are their actions. Now what can I infer about their view on IRS rates? Remember IRS rates, if you can, if I can actually try and show you something here. The IRS rates, yeah, this is like, okay, so you see here, this is a chart from the, again, the St. Louis Fed thing, website. So you can see here the 5-year swap rates, it's good, it fits our example, okay. IRS rates tend to move with the treasury rates, more or less, okay. Theoretically, the IRS rate should be higher or lower than the treasury rate. Theoretically, the IRS rate should be higher or lower. Some are saying higher, some are saying lower. Giri answered this question. Giri answered this question when I asked him about the TED spread. In the TED spread, the euro dollar yield is supposed to be higher or lower than the treasury bill yield. You forgot in TED spread.
The lower.
What is lower? The swap rate is lower or the treasury rate is lower?
Swap rate.
Okay, let's get this clear, guys. Your logic is not working. You're not thinking logically. As I said, Giri already explained it when I asked about the TED spread. The TED spread is typically a money market phenomenon, okay, because we've got the euro dollar there, okay. So there is a US dollar based discussion, okay. So the TED spread is the spread between euro dollar deposits and the treasury bill yield, okay. So here the TED spread we calculate the TED spread by deducting the treasury bill yield from the TED spread. We have already done this calculation in your here under TED. We did this 3-month LIBOR. We find out 3-month LIBOR is 4.5%. We find the 3-month T-bill is, all right, 3-month T-bill is 3.75. So the TED spread is 0.75 because 4.5 minus 3.75, okay. So normally our theoretical expectation is that the LIBOR yield should be higher than the T-bill yield because the T-bill is considered risk-free. So you can take it as AAA or even better than AAA if possible, okay. Whereas LIBOR reflects what grade of credit risk? AA, okay. So it is necessarily worse than AAA, okay. So therefore, if the grade of credit is worse than the AAA, if worse than the treasury bill yield, then the return, that means the risk is higher. The grade of credit is worse, that means the credit risk is higher. So therefore risk and return go together. So the market should expect a higher return from that. So therefore theoretically the euro dollar deposit yield should be higher than the US treasury 3-month treasury bill yield, okay. All right, so now therefore if we, as I said, and one more thing we have discussed already, whether you've understood it or not, but we've made this statement many times in the class, that the IRS yield curve, which is nothing but, IRS yield curve is nothing but if you just plot the different IRS prices. Where did we go to? That was, I think, page 13. Yeah, IRS yield curve is nothing but this. Once you get the swap rate, this last column, this is the IRS yield curve, okay. The IRS yield curve means, any kind of yield curve means it's a plot of interest rates for different maturities, okay. If you take a standard definition of yield curve, it's just a plot of interest rates for different maturities. So here we have the different maturities on the x-axis, okay, and then on the y-axis we have the interest rate, IRS rates. We have the IRS rates. So if we plot these IRS rates against these maturities, we get the IRS yield curve, okay. So in practice in the market, you'll find that although the actual term should be IRS yield curve, people will just drop the yield part and they'll just say IRS curve. So if people, and I've also done that sometimes in the class. So if I say IRS curve, actually what I'm referring to is the IRS yield curve, okay. Similarly, if I say, if I refer to the euro deposit curve or the euro dollar curve, okay, I'm actually referring to the euro dollar deposit yield curve. That is plot of euro dollar deposit rates for different maturities. But people tend to drop the word yield and just say, call it the euro dollar curve. Okay, so if you take, since the IRS, and as you saw from that example on page 7, that if you saw from that example on page 7, that the IRS rate, okay, because the IRS rates are always quoted against, if you go back to that page on page 13, that IRS curve that we saw, those fixed rates that are quoted on in the last column, right? Those fixed rates are all quoted against these fixed rates that you see here, okay? These fixed rates that you're seeing here being quoted, the swap rates, these are all being quoted against 3-month LIBOR flat. Okay, these are all by default quoted against 3-month LIBOR flat. So when you see these IRS rates being displayed in the market, what it's actually telling you is that if you want to swap, if you want to enter into an interest rate swap for, let's say, 5 years, okay, you can do that approximately. Let's take the mid price, okay, 564, let's say 562. The rate is at 5.62%. You can swap 5.62% with 3-month LIBOR. Okay, so it's clear to everyone. This is what it means. This is what the IRS curve is telling you. That this is, if you want to enter into interest rate swap for 5 years, it's approximately 5.62% against 3-month LIBOR. So you can, that means if this is the price, that means this is the equivalent. That's why I say that the IRS curve is the equivalent of the euro deposit curve beyond 12 months. Okay, this is important to understand, because this curve, which reflects the credit risk of what grade of credit risk? Again, question is not clear. See, if we are saying that I can exchange for 5 years, I can exchange the IRS rate for 5 years against 3-month LIBOR, if I can exchange it, then is it not okay to say that the IRS rate is the 5-year IRS rate is the equivalent of 3-month LIBOR for 5 years?
Yes.
Otherwise, how am I able to exchange it in the market? Okay, the market price means this is equivalent, right? Just like when you buy gold at $1,300 per troy ounce, which means 1 ounce of gold, according to the market, 1 troy ounce of gold is equivalent to $1,300. The market is willing to exchange it, so therefore we can say that 1 troy ounce of gold is equivalent to $1,300 at this current price. Is this clear? Okay, so if we see any exchange, the market is willing to exchange one asset for the other, so we can say these are equivalents. Okay, so therefore we are able to say that the IRS rate for any maturity is the equivalent of the LIBOR rate for that maturity, because the IRS rate is being exchanged against 3-month LIBOR. Strictly speaking, we should say 3-month LIBOR, because that's the maturity for which it is quoted. Is this clear to everyone?
Yes.
Okay, so that's important to understand, because as I said, this entire curve, so if you construct this curve where you have euro-dollar deposits initially for the first 12 months, euro-dollar deposit rates, and then beyond 12 months, you take this price set here, 2 years, 3 years, 5 year, 10 year, up to 10 years. You take the mid rates from here, and then you plot the IRS curve. Okay, so you've got one continuous yield curve. Are you following? You've got one continuous yield curve up to 12 months. These are the euro-dollar deposit yields, and then beyond 12 months, these are the IRS rates. Is everyone clear? What? Half the people are dead, even in the first class. Are you following, Kaneka? I don't think you're following. Your expression says you're not following, but you're nodding your head. Okay, so try to understand this, because you're able to. So the first point is essentially that the IRS rate is the equivalent of the 3-month LIBOR rate, because you can exchange the IRS rate for 3-month LIBOR as in the transaction that you saw here, as you saw here. Okay, on page 7. Here at 6-month LIBOR, we'll assume that 3-month LIBOR versus 6-month LIBOR, there's no margin. Okay, so since you're able to exchange it, it's the equivalent rate. Okay, so we are spending a lot of time on this, but you make sure you understand this concept, because it's important for understanding the floating rate debt markets and how they interact with the swap markets. Okay, this is the important point to understand here, that how they're interacting with the swap market. Now, so this is the equivalent of, therefore you can construct this. You can construct a complete yield curve for AA rated credits. I hope you guys are following. Yes. Half of them are looking down. I don't know what you guys are looking at. Okay, so you can construct a yield curve for AA rated credits by taking, in the first part, you take the euro-dollar deposit yields in US dollars. You take the euro-dollar deposit yields for 1 month to 12 months. and then beyond that you take the IRS rates, because the IRS rates are the equivalent of the 3-month LIBOR, of the LIBOR rates, right? Okay, so therefore you can take and you can construct this entire AA rated credit spread yield curve for AA rated credits. Okay, to understand, this is important to understand because this is a important benchmark for debt, for floating rate debt pricing. And then you can see how it connects to risk management also. You can see the connection to risk management here. Okay, so this is an important point to understand here, that this is a fixed floating, this is called a fixed floating IRS. Okay, now there's one more point that we discussed briefly in the last class, okay, which is that why is, so far we are following what we are saying, we are just recapping stuff. I think I'm spending too much time recapping stuff, but I see such blank expressions that, you know, it makes me want to recap stuff. Okay, so the other thing that we discussed was why, if ABC is interested in fixed rate debt, if they don't want to have floating rate debt, why should they bother to even go through the FRN market, okay, and catch their ear like this? Instead, if you wanted fixed rate debt, why not go straight into the fixed rate debt markets and issue fixed rate debt? Is this clear? This is a legitimate question. Okay, so this is what happens is that there's a concept of there's another concept that you need to be aware of, that this is a concept of, okay, so we are looking, why did ABC here not issue fixed rate debt directly? Okay, so refer this again. Okay, okay, instead of issuing an FRN and then paying on an IRS. As I told you earlier, paying on an IRS means, this market lingo is like this, paying on an IRS automatically means that you're paying a fixed rate. You're paying the fixed rate, because in an IRS, one party pays the fixed rate, one party pays the floating rate. Okay, so when we say in the market lingo, when we say ABC is paying on an IRS, it is understood as ABC paying the fixed rate on the IRS. Okay, and we say that SCB is receiving on the IRS, which means SCB is receiving the fixed rate. Okay, so these are all shortcuts that are this is just lingo, this is just jargon that is used in the market, but you need to know that. Okay, then paying on an IRS. Okay, there is this concept of, so this brings us to the concept of, important concept that you need to be aware of. I'll give you an article also about this, written many years ago in 1987, shows you how developed the markets were even then. This is the concept of swap driven issuance, which is very common in the international capital markets, so you need to be aware of this concept. Now the reason this happens is, we will just use it with respect to, we are not going to complicate the example and go into a cross currency IRS. We will just take it, the reason you have this swap driven issuance. Now typically, if we assume that these two transactions happen at the same time, the issuance of the FRN and the entering into the swap, into the IRS, if these two transactions happen at the same time, pretty much on the same day, okay, within a few hours, okay, once you finalize the FRN pricing, okay, immediately you enter into the IRS. Okay, if we assume that they happen at the same time, what does that mean? It means that in between I forgot to clarify further on Gaba's question, right? When I looked at him, I remembered that. I'm just going to interrupt this discussion briefly and go into that earlier question that we asked you, right? What does that say about the nobody interrupted me, because I got lost in some other discussion and then I wavered from there. But I asked you about, so Gaba's answer is correct. The second answer you gave was correct. Okay, so he had a bearish view because we saw that the FRN issuance was for 100 million, but the hedge that they entered into was only for 25 million. Okay, and what does that say about their short-term tactical view on IRS rates? Yeah. So the second answer is correct, it's bearish, because the reason they're not locking into the entire 100 million of the exposure, remember the underlying position is 100 million and the hedge position is only 25 million. So 75% still unhedged, okay? which means that tactical short-term view is that this 6.38 is going to get better, right? If the rates are going to fall, and then we'll enter into the balance part of it, okay? The balance 75%. So it's clear, so good, very good that you were able to quickly catch the question also. On the second answer, it was correct, okay? So so just a brief recap of that, okay? Now coming back to this, now I've forgotten what I was saying here. Okay, swap driven issuance. Now we are, yeah?
Same day interest, IRM.
Yeah, so why we are coming into this question, or we are trying to understand this important term called swap driven issuance, which is an important feature of capital markets. So it will help you to understand how swaps are connected to capital market issuance, okay? All right, so now let's look at yeah.
So the answer can be to this question that why this company, instead of issuing floating rate note, is not directly issuing interest rate swap. So
No, you can't issue an interest rate swap. Interest rate swap is a hedging product. You have to issue, what you have to say there is, instead of an IRS, you have to say fixed rate bond. Why, instead of issuing an FRN, why did they not directly issue, which is what my question is, right? Why did they not issue fixed rate debt directly? You don't issue an IRS, because there's no principal payment in an IRS. Okay, these are all interest rate swap, only interest flows are being exchanged. Okay, yeah, go ahead.
So the answer to
Okay, one sec. Bhola, can you take Prachi's phone and bring it here? Let's keep her so that she can concentrate on the class. Bring it here quickly. Or you give it to Ishan, let him come and put it here. Quickly, let's get all this done here quickly. Put it here. Somebody come and put it here. Okay, you pass it here. Just put it here. Okay. All right. Yeah. Okay. Please concentrate. I want to see people. I want to see everybody's face looking at me, not looking at your phone. As it is, you guys, I don't know what your problem is. Maybe you're not interested in the subject. But if you don't even make an effort to look here and try to understand what is being done, then the whole point is the whole exercise is a waste of time. Why are you paying so much money? You could have used this money to go and set up a business instead of wasting your money and paying money to come to a class and then you sit and do what in the class. Okay, so what's the point? It's a waste of time. You come from business families, you should understand the concept of paisa vasool. You're coming here and you're wasting your money. Maybe it's not your money, but your dad's money is also your money, right? So, okay guys, let's try and make an effort and engage with what is being discussed. Important concept of swap driven issuance. Okay, what is swap driven issuance? Why did this company have to go and catch its ear like this by first issuing floating rate debt and then swapping into fixed rate debt through an IRS? Okay, when all it wanted was fixed rate debt, because the investor markets, remember, the most important person in this whole primary capital markets business is the investor. Okay, so here this floating rate lender, this is the investor class. Okay, this is the most important market. So this is the most important person. So there are three players. There's the investment bank, the PCM division of the investment bank, the issuer, and the investor. Okay, so in this equation, the most important person is the investor. Okay, he is the customer is king. So everything has to be tailored for him, because there's no dearth of people who want to borrow money. Everybody wants to borrow money. So it's the person who's lending money who's the king. Okay, so therefore what might happen is that there are some imperfections in the debt markets, okay, because of which for instance, those who invest in bonds, okay, those who are institutional investors, typically the investor class will be institutional investors and pension funds. Okay, so do you think they are more likely to be traditional asset managers or alternative asset managers? Yes? Is my question clear? These types of investors, that is the bond fund managers, okay, bond fund managers like PIMCO and all these people, okay, a big bond fund, Janus, Fidelity. So these are likely to be, these bond fund managers and the pension fund managers, okay, these are likely to be traditional asset managers or alternative asset managers?
alternative.
Not, well, it is to some extent it's true with pension fund managers today, but these are traditionally, historically, these are all traditional asset managers. They invest only in stocks and bonds. They have all kinds of restrictions. They can't invest in derivatives. Okay, So understand this, that the typical bond investor is a traditional asset manager. The typical bond investor is a mutual fund manager who invests in debt and equity. So there'll be the debt part of the, so HDFC mutual fund might have a debt fund as well. But those guys are not allowed to go short. They're not allowed to use derivatives. They are just allowed to buy bonds and then be net long bonds or net zero max. They can't go net short. Remember all the distinctions between TAM and AM. Okay?
They just have to copy the index.
They don't have to copy the index. That is only if they are passive. But they could be active managers.
TAM, majority of the managers are passive.
Not necessarily so. There is a drift towards passive management in TAM that is happening, but it's still, you can't say that it's all TAM, it's all passive. There are active managers as well. So all of TAM is not passive, but all we discussed was that there is a shift of money within TAM. There is a shift of money from active management to passive management. But that does not mean that the shift is 100% over. Okay? So it's not that active managers are zero. There are many active managers still. Okay? So the point to understand is, why do we have this kind of swap-driven issuance? This is called swap-driven issuance if it happens on the same day. Okay? What happens is, because the let's say traditional debt investors, okay, traditional debt investors have many restrictions, okay, on where and how they invest. Okay, all right. So this may mean, for instance, in this example, okay, so in this example, this may mean that remember how a debt issue is managed. So ABC says that I need $100 million of funding for 5 years. So ABC tells the origination team of the investment bank that remember all these concepts which we are using, which we are recapping. Okay, so ABC will be the issuer. Okay, they will be in touch with the origination team, okay, within the PCM unit of the investment bank. Okay, please make sure that you guys are all paying attention and using this opportunity to recap all these concepts. So issuer ABC will be contacted by the origination team, right, within the PCM unit of the investment bank. And the origination team is also in touch with the distribution team. They are in touch with this part of the same organization, same unit. So the distribution team tells them that when we talk to investors, we don't find any demand for, I'm just giving an extreme example, but we don't find any demand for 5-year fixed rate US dollar debt. So investors are not interested in buying fixed rate US dollar debt for 5 years. Are you following? This is just investor preference. Just like people did not want to buy netbooks, smartphones came up, and so people rejected netbooks, and netbook manufacturers suffered a big loss because everybody started buying smartphones. This is just because customer preferences have suddenly shifted. Okay, so the fixed rate investor, the debt investors to whom everything has to be sold, they are the customer, they are the king. And we look at customer preferences, and the distribution guys talking to the customers, the investors, they find that there is no demand for 5-year fixed rate dollar debt. Is this point clear? Yes. This can happen. This is just a market situation that the customers want to buy smartphone. They're not interested in netbooks. Okay, is this clear? So the market situation, but then you see how an IRS can be used to satisfy both ends. On the one hand, you have the issuer, and on the one hand, you have the investor, and the investment bank is in between. Okay, and how we use an IRS to satisfy both sides. Okay, but obviously the customer is the investment, the main king is the investor. The investor does not want fixed rate dollar debt. He wants floating rate dollar debt. Maybe the investors have a view that short-term interest rates are going to rise, so they want to invest in floating rate dollar debt. Are you following the logic? Yes. If investors are of the view that short-term interest rates are going to rise, then they would prefer to invest in in floating rate debt, because then as 6 months LIBOR keeps rising, their returns will start going up. In contrast, if they had bought fixed rate debt, they are not going to get that benefit. So if investors maybe feel that fixed rate, short-term interest rates in dollars are going to rise, so they are now looking for floating rate investments. Okay, when they talk to the distribution team in the investment bank, they are saying, give me floating rate debt. I want to buy floating rate debt for 5 years. I want to buy floating rate US dollar debt for 5 years. Okay, is this clear? Just a customer preference. Okay, so now what we do is, so therefore what they do, this is how the swap driven issuance works. There is no investor demand. Issuer wants to issue fixed rate 5-year debt, $100 million. But when the distribution team talks to the investors, they find there is no demand for this kind of debt, but there is demand for floating rate debt. Okay, so what you do therefore is you do the issue as an FRN, because you have to satisfy the king, who is the investor. The investor wants floating rate debt, so what they do is they issue floating rate debt to satisfy the investor. Okay, so ABC will issue floating rate debt to satisfy the investor, because, and that they are happy, because, and they will get good pricing because there is investor demand. So if there is if I like an iPhone, I will pay more for an iPhone than I will for a Xiaomi or whatever it is, right? Because I have although it does the same job, but I have a brand preference for iPhone. So here, if I have hunger for floating rate debt, maybe I'll be able to give the issuer good pricing on floating rate debt. Are you following? Good pricing. If I'm paying so much money for an iPhone, that's good for Apple, because they're making bigger margins. So because I'm hungry for floating rate debt as an investor, I am able to give the issuer very good pricing. Are you following? Okay, so the issuer gets the advantage of good pricing. They are able to issue at 6-month LIBOR. Maybe in a normal situation they would have had to pay 20 BP over 6-month LIBOR, but because now there is tremendous demand for floating rate debt, they are able to issue it at LIBOR flat. Okay, so now what they do is, now the investor's problem is solved. The investor's problem is solved because he wanted floating rate debt. He wanted to invest in floating rate debt. Once the FRN has been issued, he has got what he wanted. He is able to invest in floating rate debt. Okay, but the issuer's problem remains, because the issuer has now been exposed. He is now exposed to floating rates for 5 years, and he does not want that. He wants to have fixed rate funding, so his cost of debt is all locked in. Are you following this?
Yeah.
Okay, so therefore he wants to have fixed rate debt. So now what they do is they just do a hedge. They don't disturb the underlying position. The underlying position is this, the FRN that they have issued. Try to understand this from your risk management framework which you studied earlier. Okay, so the underlying position is the floating rate liability because of the FRN. Okay, they are not happy about the net position because it is exposed to floating rates. Now what they do is, without disturbing the underlying position, you can't go back to the investor and snatch back your FRN saying I don't want to issue floating rate debt. You can't disturb that side. So you let it be, and then on a parallel basis you set up a hedge so that your net exposure is fixed. Are you following what I'm saying? So now you see how an IRS can be used to satisfy both sides. So the investment bank says, fine, don't worry, we'll give you net fixed cost of debt. So you do the FRN, let's satisfy the investor, give him floating rate debt which he wants. Let's complete the issue, because this allows you to raise capital. Because remember, in this figure 1, there is a principal flow. The investor will invest $100 million with the issuer. So the issuer, this is a primary capital market issuance. So remember what will happen, there will be fresh issue of securities and there will be net inflow to the issuer. You remember all that, which we studied in PCM? What is the difference between a secondary capital markets transaction and a primary capital market transaction? Everybody's forgotten all that. What? All are half dead now. Everybody's forgotten. What was one of the features of the PCM transaction was that the change in the balance sheet, but how exactly, or which two accounts? The two accounts that are affected as securities issued, okay, or so let's put it as or inflow of funds, okay, inflow of funds on account of money received or paid on account of security issuance. So it's clear, okay. So if this, we define it this way, this will capture even bonus issues, okay, which we will have to classify, because you have to classify everything as some category or the other, otherwise your taxonomy is not proper, okay. So there is an inflow. The most common way to look at it is that there is an inflow to the issuer in a PCM transaction, either inflow or outflow. If you do a buyback, then it's an outflow, but there is an inflow to the issuer, inflow of funds. In a secondary capital market transaction, there is no inflow of funds. Is everyone clear? There is no inflow or outflow, because it's between two investors in the market. They are not concerned with the issuer is not involved in a secondary capital markets transaction. So this is a PCM transaction in figure 1. It's a PCM transaction. So by satisfying the investor, what we have achieved is we have ensured that what the company needed, primary capital markets, raising of capital, the company got what it needed. It needed the funds. So there's an inflow of funds. Is this clear? Okay. Now what we do is we take care of the second problem because the issuer is still exposed to floating rate debt, which he does not want. But we don't disturb the underlying transition. We set up and we do an IRS as a hedge. Okay, so here we'll take a simplifying example that we do 100% hedge at one time itself. Okay, this is why you have swap. This is what is called swap driven issuance. Okay, so here immediately the same day, within a few hours of completing the FRN issue, they will enter into a swap with SCB. Okay, so SCB is Standard Chartered Bank, because I wrote this book for Standard. When I wrote this book, I was a Standard Chartered. So all example is for SCB. Okay, so SCB because this was written for customers of Standard Chartered Bank. So every bank, all the banks are actually SCB here. Okay, so is this clear now? So typically what will happen is that the same guy will try to, this is one of the advantages of having an active investment banking presence, okay? That if you are able to lead manage a lot of issues, when you have to do the IRS transaction, you can also get the benefit of the IRS transaction. Because remember, this IRS transaction, the bank will make some kind of margin on this transaction, because they're doing a transaction with a corporate customer. They will make some kind of profit on this transaction generally. So every investment bank wants that when it is doing primary markets business, it should also get all kinds of side business. Like if there is a foreign exchange transaction involved, then I should get that transaction because I lead manage the primary capital markets business. Because this is the most important aspect of a corporate treasury, raising capital. Everybody is dying to raise capital. Okay, people are willing to make all kinds of concessions for anybody who will give them money. Okay, either you give directly as an investor or you arrange the financing as an investment bank. So those investment banks which can arrange big amounts of financing, they are in high demand because everybody is hungry for money. Okay, every corporate is hungry for money. So whoever can provide finance either directly or indirectly is a big shot. Okay, so what these investment banks will try to do is using their leverage. So if I'm arranging $100 million FRN for you, I have some leverage. If I'm an investment bank, I have some leverage. Okay, so now what I'll try to do is I'll try to arm twist you as the issuer, because I'm saying that, okay, look, I gave you this money, I raised this money for you, now you give me the foreign exchange transaction. If this is, let's say, an Indian issuer, okay, let's say this is Videocon or somebody, an Indian issuer issuing in the US dollar euro markets, maybe he wants to sell the dollars eventually and use this fund in India. In India, you can't buy stuff with US dollars. You will have to convert this US dollars into Indian rupees. So then let's say Citibank is arranging this issue, is the primary markets, is the investment bank. Then Citibank will ensure that their Bombay Treasury will get the foreign exchange transaction. So the Bombay Treasury will be able to quote on $100 billion dollar rupee transaction. So they'll make some money out of that. Okay. Then Citibank will also try to convince the issuer that you do the IRS with me. Okay, instead of doing it with the Standard Chart, you do the IRS with me. So then on the IRS also they'll make some money. Right? Okay. So this is how the business works. Okay. So but now get back to the whole idea of swap driven issuance. So if you do both the transactions on the same day, can you see that both parties are happy now? Is everyone clear? Make sure that you satisfy yourself. Himani, are you following? Okay. All right. Okay. So please make sure you understand this, that here you have satisfied, if you do both the transactions on the same day within a few hours, then you have satisfied both the parties. Is that clear to everybody?
As if this case is in the same country, I mean, they are not doing cross currency swap.
No, they are not doing cross currency here. I wanted to keep the example simple, so I'm discussing it as a simple same US dollar based transaction, but you can actually make this across countries also. But let's understand, because I don't want to overcomplicate the example. Okay, first let's understand a simple example of swap driven issuance. Okay, and then we can make it more complicated. Okay, but is that your question is answered? Okay, yeah.
So the same system will follow in the intermarket transactions.
No, I didn't follow what you mean. What do you mean by intermarket transactions?
Like
Quiet. When one person is speaking, everyone has to be quiet. Yeah.
oh, the same system will be followed when it will be between two different
currencies.
Yes.
Okay, we'll come to that. That's a more complicated example. First, I want to make sure that all the sleepers, first period, everybody is already half asleep. Shivani, you're not feeling well. Are you not feeling well? Then you can go. I won't cut your attendance. You want to go home? Okay, then you just relax. You can sleep. If you're not feeling well, just put your head down and sleep. Okay. All right. But everybody else, please make sure you're engaging in the class. You're engaging with what is being discussed in the class, okay? So that you give yourself the best chance of remembering all the stuff. So let's first be clear about a simple case of swap-driven issuance with only one currency involved, okay? What is swap-driven issuance? Here we say that this FRN issuance we say is swap-driven issuance, because remember, the moment we say issuance means we are referring to a PCM transaction. Okay, the IRS is not referred to, doing an IRS is not referred to as issuance. It's just called doing an IRS because there's no issuance there. Okay, issuance is only happening in the PCM. So when we say swap-driven issuance, here we say that this particular FRN issue in the US dollar capital markets, this is swap-driven issuance, because had it not been for a favorable swap rate, this guy, because eventually this ABC, let's say ABC's benchmark was, when they are talking to the origination team of the investment bank, okay, they are saying, okay, I'm willing to do this. I really want to issue fixed rate debt. But if you're telling me that I can indirectly achieve a fixed rate cost of funds, but you make sure that I am able to get better than 6.5% fixed rate, because every treasury has some benchmark. Remember in your project financing, hurdle rates. Remember hurdle rates, NPV. You never heard of hurdle rates?
Yes, sir.
IRR has to be compared to what? When you compare the IRR of a project, you compare it to what? Some kind of benchmark hurdle rate, and then you decide whether the project IRR, you've forgotten everything. I mean, it's just shocking. All your basics of NPV and IRR, everything you've forgotten. So every treasury, now you remember, is your memory jogged? Have I jogged your memory? Anybody who went jogging in the morning, maybe I should jog your memory once again. Okay. Hurdle rate, yes, Ria has suddenly woken up. When she heard the word jogging, she suddenly woke up. Okay. All right, guys. So you remember all this stuff or no? Maybe you should go back and check. When you do the IRR, when you calculate the IRR of a project, okay, when you calculate, what do? The IRR is 15%. How do you know it's good or bad? You will have some hurdle rate for investments. Maybe your hurdle rate is 12%, then you say, okay, 15 is greater than 12, so I can accept this project. That's how it's used, right? That is one part of it. So the hurdle, so every treasury has some kind of benchmark in mind, some hurdle rate. So the treasury is telling the origination team, okay, fine. If you want me to do all this roundabout way of issuing fixed rate debt by first issuing an FRN, then entering into a fixed floating IRS, I'll do it, but you make sure that I can get 6.5% or better. That's how they're going to think. They will have some benchmark, so they will say, okay, you do whatever you want, but I have to get a net cost of debt should be less than 6.5%, less than equal to. Is this point clear to everyone?
Yes, sir.
Okay. Yes.
We have to
You have to, those who have to go for interviews. The whole class has to go for interviews. No, only those who are in suits can go. Only suited, booted character. Ishan cannot go. Although Ishan is the most restless. We'll have to put him, next class we'll put him in a cage. Okay, suited guys, please quickly. And don't minimize disruption. Where are you? Are you suited? This is your dress. Okay. Minimize the disruption. Okay guys, the rest of you keep concentrating. The rest of you keep concentrating. Quickly, quickly. Where are you going? You can go, how can you go for an interview like this? Okay, all right. Okay guys, let's concentrate now. Okay. So are you following the logic? How the corporate treasury works? The corporate treasury will have some kind of benchmark hurdle rate saying that, okay, I'm happy with, in the context of that hurdle rate, that will come from some kind of cost of capital, out of which the cost of debt will be a one component of the cost of capital. Okay, so they will have some hurdle rate for debt also. They will say that I can't pay more than 6.5% for 5-year fixed rate debt. So you make sure. So this, therefore, what the investment bank does is they look at the swap rates. They look at swap rates. They look at, quiet here, okay? They look at what is the swap market, because the swap market is also moving up and down. It's not just staying flat. It's moving up and down. So they look at the swap rates. They look at what price they can issue the FRN. They look at the investor demand. So everything is managed as one transaction effectively, okay? Although it's two separate transactions. So this is why you call it swap-driven issues. When Citibank sees, okay, in this case, okay, so it's a Standard Chartered, when they see that they are able to issue the FRN at LIBOR flat, okay, the investor demand, the book building shows that there is enough investor demand, the LIBOR, the FRN will be issued at LIBOR flat, okay, FRN pricing will be LIBOR flat, and then they look at the IRS prices, they feel that it will be below 6.5% for 5 years, okay, then they go in and lock in both the transactions. This is clear. They do the FRN and then they lock in into an IRS so that ABC is able to get a net cost of funding below 6.5 what they wanted. Is everyone clear about this?
So how they fix this fixed interest rate of 6 point be below 6.5? That will be done by ABC incorporated with SC.
No. This is a function of market prices. You observe the market, because you can't influence the IRS market. It's very big. You can't influence that market, okay? It's very big. So you just observe market prices. If you feel that market prices are below 6.5% and they are likely to remain there, then you go in for this transaction and then you're able to lock into this rate. You can't influence this price. You can only observe the price, and when it falls below your target level, then you can go in and attack. Is this clear? Okay. All right. So now you understand what is meant by swap-driven issuance. That essentially investor preferences, a swap-driven issuance, the presence of the IRS market, okay, the swap market overall, currency swap, cross-currency IRS is also one way of doing this. But we take the simple example where investor demand is for one type of security, for floating rate debt, let's say, but the issuer wants fixed rate debt, okay. So by using the IRS, you can engage in swap-driven issuance. Here what we say is this is swap-driven issuance, because this issuance would not have happened unless the swap was also favorable. Are you following? Unless the IRS rate was also favorable enough to allow ABC to secure what it wanted, okay, this issuance would not have happened. That is, there is no natural issuer wanting to, there's no natural supply of 5-year FRN floating rate debt. That's what we mean by swap-driven issuance. Swap-driven issuance is unnatural issuance of some sort. Are you following what I mean by unnatural? Because there is no natural supply of 5-year debt, because nobody wants to issue 5-year debt. The issuer that is there wants to issue fixed rate debt. But it is issuing for floating rate debt because that's where the investor demand is. And then immediately, and it is only doing that because the swap rate is also favorable enough for it to achieve what it wants to achieve. Are you following? Slightly more complicated transaction, but is everyone following the scheme? Make sure you revise it later once again and understand this concept. So this gives you an understanding of capital markets. I will essentially I will write up the details a little bit more, but you should understand this transaction from here itself, okay? So you have swap-driven issuance, which means that you have investor demand in a particular segment, a particular type of debt for a particular type of debt, but the issuer wants to issue a different type of debt.
And how the bank deals with the risk of that?
So the bank essentially, this is actually a book. Now IRS is a type of instrument. Okay, it's a debt market. It falls in debt as an asset class. Okay, it's an instrument. So in every bank treasury, you will have a dealer, just like you have foreign exchange dealers. So you will have a market maker and IRS.
Authorized dealer.
Kind of like an authorized dealer, which we use, that expression we use only in India. Okay, for foreign exchange dealers. So these guys, the SC Standard Chartered will have a IRS market maker. Okay, remember when we talked about the secondary capital market and the overall market making operation as one type of operation. Okay, the market making operation is one type of operation. So in that you have all kinds of markets and instruments. because you have spot, forward, futures, options, and then you have currencies, commodities, equities, debt. Okay, so in all of these boxes you will have market making. So there will be one which falls under the column swaps, and the row will be debt. The row, I'm just going back to that framework, okay, where we have asset classes, markets, and instruments. So the column will be swaps and the row will be debt, because these are IRS transactions. So in Stanchart Treasury there will be a desk which is making markets in dollar IRS, another desk which is making markets in sterling IRS. So that guy is running a active risk book or a passive risk book? Active risk book. Okay, so he's a market maker, he's a class of speculator, he's running an active risk book. So that guy will have basically one guy will come, ABC will come and pay on a IRS here to that guy. There's SCB, there's an interest rate swap desk, okay, which is dealing with the transaction. Then maybe after a few hours, Bank of America comes and receives on an IRS for 5 years. So that guy has, since he's market making, he's there in the market, so he's quoting two-way prices, okay? So people are hitting him on the bid and offer like any other market maker. So his position is constantly changing. So he will keep a track of his net position and he will see where he is, and he will take a view on market rates, and he will decide whether he wants to square his position or not. Is this clear? So that's how that risk is managed. So that trader will have to manage that risk, and he will have his own risk limits and all those. That's where the risk management guys will come in from the middle office. Remember middle office? So the trader is sitting in the front office. The market maker is sitting in the front office. In the middle office, okay, we have put the risk management guys. That guy will come in and say, look at your exposure is exceeding the risk limit. You better cut down your positions. Okay, that kind of exchange is going to happen between these guys. Okay, so this is how this risk is managed.
Actually, in swaps, I've read somewhere that the two companies interchange their principal amount. For example, if I have a subscription.
Yeah, that's a currency swap. That would be a currency swap. Okay, that will typically be a currency swap. In an interest rate swap, you would not exchange. In a single currency interest rate swap, we have to study swaps also as a separate instrument. But I introduced at least one type of swap here to understand this concept of swap-driven issuance as part of your debt capital markets discussion. So that if you want to read up, you can read up this book. You will find a detailed discussion of all currency swaps also in this transaction. So that what you're talking about, that is currency swap with initial exchange of principal.
Sir, I was asking that in that case, the bank does not take the risk of fluctuations.
No, the bank may or may not. See, that whether the bank will take the risk or not take the risk or match it off with another transaction, offsetting transaction in the market, that is the decision of the swap dealer. That is the decision of the swap dealer on the market making desk. If his view is that market prices will move in his favor, he may keep the position for a while. So whether or not the bank will square the position immediately, okay, in the market or keep the position, that is a decision to be made by the swap dealer on the IRS desk. And he is responsible for his decisions. So if he loses money, then he has to, be accountable for that. Okay, so I can see people are getting restless. So let's look at the time. Okay, so we'll let you go. So our coverage is very slow, but at the very least, we should make sure that even with this coverage, people are not able to, I think, follow everything that is being discussed. Okay, so please engage in the class okay. So tomorrow, next class is, unless you can change it with Lalita, if it's your problem, whatever you want to do, what Vaibhav wanted to do, okay? So whatever you do, please let me know also and follow those rules. No 9:30 class on Saturday or Sunday, but and no double class on one day. Okay? Okay, you can go.